Hi, folks. So, everybody in the market wants expert advice. Everything that we hear on television, in business papers, is in on online forums, uh, in business magazines. It is all oriented towards trying to predict which stocks to buy, what sectors to buy, how the market will behave. Almost you can say that if prediction were to be removed from all these sources of information, there would be nothing left there. The core, news based, unopinionated content is just not available. Every item, every article is trying to push you in one direction: buy this, sell that, consider. I mean, the main leading pink papers are openly, trying to predict on a stock wise basis. Next 3 months, these stocks will go 41% up. I mean, these kind of predictions are there. The entire YouTube, entire media on business channels, tons of experts are all trying to uh, you know basically. So in this video, we will basically look at some statistics on how successful predictions are in the market. I am, of course, very, very convinced on not going that route, but that is what really keeps people engaged in the market at all times. People keep trying to predict things, and even if they were to get half of it right, even that would be very good. But even that is not happening. So let's dive in. So this illusion of accuracy is there, where you know uh, if somebody has a great following or is influential in some way, people think that the uh, prediction would come true because of their experience, because of their uh, perhaps gray hair. But the experts directional forecasts, whether the market will go up or down, whether this particular stock will go up or down, is consistently worse than a random chance. That is the truth of it all. And it is just 47%. So there is statistical evidence that forecasts and probabilities that most experts will voice, uh, there's only 47% chance that they will be right. So we went and saw some studies that have been done on this, some empirical evidence, uh, and we found many studies. So there was a CXO advisory group study from 2005 to 2012 data, and it found that only 47% directional forecast by 68 experts, and this is based on US markets, and Indian market is certainly not better than this in terms of when it comes to predictions. So 6,584 directional forecasts were given by 68 experts in this study. Uh, and some names are also there. Jim Cramer was at 46%, Abby Cohen at 35%. And they analyzed S&P calls. 66% of experts scored less than 50%. Only 5 experts exceeded 60% of the times in calling it right. In American Century Investments, this was an 8-year period study. Again, the key accuracy metric was 47% accuracy. Track record showed that predictions are educated guesses, often failing due to uncertainties, because there's so many moving parts in any market that you just cannot do predictions. There was a Rick Kahler, Larry Swedrow analysis, again 2010 to 2022. Only 27% of major calls by experts were found to be correct, which included interest rate and even return predictions. Experts were wrong on dollar strength, emerging markets, inflation trends since 2008, except one person. So there are so many studies that point out to the same. There was another one, Global Analyst Earnings Forecast, 2004 to 2016 data. 12-month earning predictions for listed companies in 70 countries. Experts overestimating growth, especially for low growth firms, and emerging markets were the worst here with 35% bias. Actual earnings were 20% below forecasts on average. 20%. So this fetish that people have that, let's listen to XYZ, he's going to tell me which stock to buy because he knows what earnings are going to come, is basically just a shot in the dark with perhaps less than 50% accuracy. So if you are betting your hard earned money on, somebody's bet, somebody's call on some stock or market, you are basically shooting in the dark with a likelihood that, it's no better than flipping a coin. So why does it happen this way? I mean, there are so many experts and they have so much experience. They should be able to predict what's going to happen, right? I mean, just like uh, there's so many non-market people also want to predict basis perhaps astrology or basis some other ways of looking at the market, but nobody is able to do any significant prediction of accuracy of any kind because there are so many moving parts in the market: geopolitical shocks, earning surprises, black swan events. There's so much noise in the system that mathematically it is impossible to model or foresee what's going to happen. You can only assign probabilities to outcomes. So, for instance, a momentum strategy has some probability assigned to a stock that is moving up that it will continue to move up. A stock that is moving down, there is a probability assigned to it that it is likely to be moving down, and that's what creates a outcome which is certainly not predictable, but from a probability perspective, it becomes slightly more advantageous to your end. So, for instance, if you're doing 100 trades in a year, and let's say the prediction on each trade is worth only 50% chance of winning, so you 50% times you win, 50% times you lose, but each time that you win, you want to win bigger, and each time you want to lose smaller. So even with a 50-50 uh, ratio, accuracy ratio of your overall bets, you can still make a lot of money because on each right bet you will make money much bigger than what you will lose on each wrong bet. So the idea to keep your winners running and to keep your losers small actually brings together this math, which is also called the casino math, uh, that works for portfolios. The other reason why this prediction business unpredictability happens is that experts are also humans. They are also studying these companies or markets all the time, and they too can get very biased. uh, Also, a lot of them need to ensure that they are able to keep generating that kind of a uh, you can say business for their equity products, for instance. Until you are out there and showing an optimistic bias, people will not come and buy your products unless you say, just blindly sip and come to my mutual fund or whichever product. I'm not blaming mutual funds for anything. uh, so people have just assumed that come to the market, invest, and automatically money will get made. That will not continue to happen. We are in that phase in the Indian cycle where it is happening more or less. But look at China. I mean, last since 2008, they've not made any money, poor guys. Japan didn't make any money for 35 years. Germany, France, UK have all gone through very long periods where they didn't make any money in the market. So this, basis of optimism, uh, based on what has happened in the last 10 years, 20 years, again, can cause a lot of overestimation in terms of what has been happening and what can continue to happen in the future. Also, short term predictions, whether they are daily, weekly, monthly, they tend to amplify the errors. So, there's a natural course of a market growth. Let's say for the next 10, 15 years, let's not worry about that there will be growth in Indian market, lack of growth in Indian market. We will grow at 5, 6, 7%. And The decent companies in our markets will continue to grow, perhaps a bit more than that. So 10, 11, 12% you can say. So a natural growth path is already there unless somebody really screws up big time. If the economy is growing at 6% and you are having some market share and some lead advantage, you will grow at 10, 12% unless you screw it up. So there is a runway of automatic growth that is available when such conditions are um, available. Now, within that runway, let's say 5 year CAGR of a one company could be, let's say, 12%. Now, it can very well happen that for 3 years there is no movement, and then for the last 2 years the market rewards with a lump sum gain of 50% to make up for that 3 year uh, stagnation. So for the very short terms periods, prediction is very very difficult. But over a 5 year period, if you assume decent underlying growth in the economy and some additional nominal returns on your stock, you can still make some prediction that unless the management really uh, there's some unpredictable competition that comes around or technology disruption comes around, this will likely to go on for some time, but that's usually already priced in. So the market will also do in the very short term random walk, where you know last week we were not expecting a sell off. To this week, just on Monday itself, we got a sell off. So you can't really say what's going to happen tomorrow. Tomorrow, perhaps we'll go another 2% down on many stocks, or we will go 3% up. Can you say, the more you come down in your prediction horizon, the more difficult it is to predict. So 1 day is difficult to predict, 2 hours is even more difficult to predict, 15 minutes is even more difficult to predict, 1 minute is even more difficult, so on and so forth. So while we saw US studies on this, there are enough examples in India market also. And Indian market analysts are even more, gung ho about optimism usually. And nobody, of course, could see the 2020 crash or the 2021 rally. In fact, post the crash, rate hike cycles, nobody was able to predict really. Many wrong turns there. Sectors that had been languishing for 10 years, defense, IT, PSU, suddenly surprised in the last few years. So a lot of surprise element continues to play out. And if we see a hypothetical case, this is sourced from Morningstar, that what if you were able to put, let's say, $12,000 for 10 years in five different ways. One was perfect timing. So you were buying exactly at the low of each year. The second was the first of the year. So every year, first of the year, you were investing your annual money there. The third was dollar cost averaging. So you are gradually bringing in money over that period of time. Fourth was perfectly wrong timing. So you choose hypothetically, you choose the highest point of the year and you invest your annual money in that on that day. And fifth was holding cash and doing no investment. So these five options, hypothetically, if you were to uh, analyze, can you guess which would have been what would have been the returns in each case? Which one would have actually done the best? Obviously, the perfect timing would have done the best, investing at annual market low points. So those $12,000 each year for 10 years became $240,000. If you invested on the first of every month, you are not so far from the perfect uh, timing model. You were at 226. If you did dollar cost averaging, you were at 219. Again, not so far from the likely most perfect portfolio. And if you perfectly timed it somehow, you again were not too far from the perfectly timed one. And it is only the case that you did not put many money in the market that you really were far from the best outcome. So, what this is telling you is that regardless of what you're doing in the market, unless you do something stupid like number five, where you will not invest, every other case you will make some money, decent money, maybe not the best, but very close to it. So, it tells you some very, very important points. And the point here is that you have to move from prediction to participation. that you have to participate in the market. Forget about this fetish of, I can predict the market and hence I will get in as soon as the market starts to take off and I will get out as soon as the market starts to go down, or a stock. It just doesn't work. It just doesn't work. Believe me, I've been in the market for almost more than 30 years now. It doesn't work this way, at least for 99.99% people. So you have to focus on your long term journey, not on daily, monthly, or yearly predictions that I will bring in money when this will happen. I predict this to happen. Three predictions going wrong and the money has to be significant. If you are worth 100 rupees and you're playing with 2 rupees in the market, then nothing will happen, even if you make a lot of money on those 2 rupees. So you have to, you know, give decent allocation and not try to predict the market. The second step to this is that post participation. Yes, you are in the market now. You are not trying to move in and out of the market. You are in the market. Now you have to move from discretionary to some rule based participation. So, this whole idea of somebody, my friend told me, buy this stock, sell that stock, all that you can do as much as you like. You will not be able to beat even the index with that in most of the cases, because you are following some very famous personality, some very famous investor. He's not coming to your house to tell you that yesterday, yes, I bought this, but the next day I've sold it off. You will come to know 3 months later, or if he has doubled down on his position, or whatever it may be. So having, following somebody else's conviction, or waiting for, some TV anchor to tell you what stocks to buy or sell, I think those are the worst ways of investing in the market. You have to go and make rules or follow somebody who's making rules, and follow those strategies, because you have to eliminate one thing. You have to eliminate the emotion. You have to focus on the rules, you have to focus on exits, and you have to cut out the emotion from the process. It could be any format of investing. It could be value investing, it could be momentum investing, it could be any other way of investing, but you have to stick to certain rules. It is just like you take your car in a on a highway, and there are a lot of cars around you. If you are not going to stick to some rules, you have participated on that highway now, but if you're not going to stick to the rules, if you just go here and there, low speed, high speed, cut here, cut that, the end is very clear, right? So you have to participate and perform as per some rules to make sure that you will reach from point A to point B. So that's what I have in this video for you to think about: how you approach the markets and how you play the markets. How much do you give importance to experts' prediction? Please let us know in the comments. Maybe one good idea could be to gather ideas from the experts and then do your own homework and see whether it fits your rules or not. That can be one way. But just to rely on somebody's prediction is certainly not the way of winning in the markets. If you like this content, do like and share this video. You can also join the Weekend Investing Community. You can drop your email in the link in the description. We'll send you more premium insights. If you want to watch more content like this, there's one on the screen. And certainly do subscribe to our channel. Thank you. Bye.